Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
All right, so let's jump right into the second half of this interview with Mike Mothner from Wpromote. In the first half, we talked about their partnership with Shamrock, talked about how Mike and the team grew from $5 million to well over $150 million. In this part of the episode, we're going to talk more about the actual transaction, how they prepared for that, what it was like, the use of debt in a transaction, how it differed from the Shamrock transaction to the ZMC transaction. I think there's a lot of really good information in this, so let's just go jump right in.
So question, when Shamrock did the deal, and I'll tell you why I'm asking, a lot of times private equity groups to accelerate their returns will put some debt onto a transaction.
Yeah.
Did they use some debt?
Yeah, they used some debt. Not a tremendous amount of leverage. I think one of the things, I mean, you know this well, but probably for your audience, it is important to understand the amount of debt that's put on the business because it dramatically affects. It can dramatically affect. I mean, if it's too much debt, it means the debt service itself could be damaging to the business. But it also, the debt obviously has to get paid eventually, right? So, and the debt gets paid first in a transaction because they sit at the before any equity holders get paid. So Shamrock put in, equity check, which has no debt, but that they get equity for that. Now, that's also helpful, I should say, because it allows for less dilution to happen, right? So if part of the deal is funded, so this was, provided liquidity to myself and other equity holders versus money going to the balance sheet because we really didn't need it. Not all private equity firms are okay with that. A lot would say, hey, we want our money to go on the balance sheet because then it's actually money in the business versus going to the owners. In this case, that wasn't what we were looking for in the transaction. And we didn't need that because some businesses need a lot of cash to produce a product. In this case, our product is profitable. So I think so they did put debt down in the business. As it happens, because we continued to grow and be profitable, by the time the transaction happened, the debt was paid. And the same, I hope, happens again. There was part of the ZMC deal, there's debt, because that's the mechanics of how these deals, almost all of these deals have some debt. But my hope is at the point that we go public or have enough transaction in 4 years from now, we will have used existing cash flow to pay that debt. And so that's no longer a burden.
So here's my question for you, which I know is one that a lot of entrepreneurs share. We have cash on the balance sheet. We're making money. We're profitable, everything else, right? How did you feel about the notion of putting debt on a company you'd never had debt with? How did that sit with you?
Some people have a real challenging relationship with debt. I don't. I think I just, as a math focused person, the idea that you're leveraging debt to create value with cash, even if just personality wise, even if I can own a house outright, if I can have a mortgage on it at a really competitive rate, then I can put that money to you, at 4%, sure. I can put that money to use and make 12%. I'm doing significantly better than being debt free. So I don't have a challenging relationship with debt, with a manageable amount of debt, because I look at it as leverage, and leverage is an incredibly powerful thing. So I didn't have much consternation about debt on the business. I think the thing that was a much more significant paradigm shift for me is having a partner in the business, a partner that is, a sophisticated financial partner. That was a new type of pressure that I think drove performance, but certainly it took a while for me to get, I'll never forget, the deal closed on a Friday and it was like Monday morning, you have this realization, they just paid for everything I've already accomplished. As of Monday morning, I've accomplished nothing. I'm at ground zero of accomplishing anything for this new partner. And so for me, I felt a very much, separately from my equity in the business, I felt very much a moral and internal obligation that, and not only that I want them to look back and be glad they invested. From the competitive sense, I told Steve early on, I want to be the best investment you ever made. And actually, on a funny note, I don't think mathematically we're the best, but we're right at the top. We're in the we're right. Like
Good spot to be.
one of the best.
Let me unpack a couple things because this is terrific. Just to clarify on the debt, nothing else you had to do. Shamrock did all that. You didn't have a personal guarantee. It didn't really change anything other than you got to retain more equity.
Yeah.
And some of your future profits had to go to pay that off.
Correct. And I will also say I had to that point had personal guarantees left and right. My running joke was like, I have over personal guarantee. I'll sign another one because I've already, I've like 5x'd my, if something goes wrong here, we're going to have to find
the ship's upside down, right?
So I also like, some people also have a aversion to personal guarantees. And you should, if you don't control your company, right? If you're not able to make decisions, you shouldn't have a personal guarantee because there's a big disconnect. But I always had this feeling like, hey, I'm comfortable betting on myself. And so, and early on, hey, but I had to put a personal guarantee to even do anything. So like, so be it. And once you sign it one time, it didn't bother me to sign 5 more of them. So putting the debt on the business actually allowed me to get my personal guarantees off the business. And that took some time, but that actually was, kind of a positive in that sense.
Yeah. So then now you have a partner, a couple of things there. I think there's a misnomer. I mean, Shamrock, for example, which is a top tier group, Shamrock wrote a sizable check, right? Regardless of whether they have majority or minority, they A, don't want to lose any of that, and B, want that to be one of their best investments ever. So whether they're minority or majority, they are just as invested in the outcome of that investment as if they were majority, correct?
I don't think they look at it at all differently. I think they look at it and say, we put X number of dollars from our fund in it and we wanted to return, and whether that represented 80% ownership or 20, I don't think it makes a difference. I will say when they structure the deal, when it's a minority deal, they have to spend extra time putting in, kind of guardrails and controls in case
negative controls.
Yeah, in case I do a horrible job, and just things just to make sure that their investment's protected. Those, hopefully are never, you spend a lot of time wringing your hands about them, and then you never put it in a drawer and never look at it again. But yeah, they look at it the same.
So then, and maybe you could talk about this. I'm going to call it this unknown fear that I think a lot of entrepreneurs have. So now I have this bunch of smart guys. They think they're smarter than everybody, all the things people say about private equity. And one day they're going to show up and say, Mike, we got to start doing this now, or we got to start doing that now. Isn't it really like, nobody shows up with surprise ideas. We huddle, we plan in advance, we do projections, we do a whole lot of stuff so that everybody's on the same page with what the future of the business look like. Is that what your experience was?
Yeah. So my experience has been, and I should take a step back, and we have a good portion of our client base that are private equity backed, so we get to see a lot of those relationships through that lens. And just now having gone through 2 PE transactions, I've gotten to know a lot of different PE groups. And they're not all the same. They're all smart. They're all focused. They're all good at making money. I mean, there's some common traits. They're, in my experience, and in my now two experiences, it's very much aligned. They are not coming. They are investing in a management team that has a vision. They're investing in you. Now, I should comment. There are areas, and you know this, but there are areas of private equity that are not. Turnarounds are very much not. You're buying a troubled company. You should expect they're going to come in and be very forceful because they're buying a company that hasn't necessarily made the right decisions. And some private equity companies have that especially those that are super sector focused, they might have a really defined playbook of how we believe things should happen. So you should make sure, if you're thinking about PE, that you understand which flavor of private equity they are. If this is all we do is buy SaaS companies and we've got a very, very defined playbook of how you run a SaaS company, you should go in eyes wide open that that playbook is going to be run on you, and you better be on board with that. In our particular case, and I think in most of the probably conversations that you have, they're investing in growth companies. They're excited about the industry. They're excited about what they're doing. They want to be there to support and help, and they want to make sure you don't mess it up. But generally, they're there to support you. Now, they're going to ask lots of questions, and if you slip, they're going to want to understand why. And if we're I think I have no doubt that Shamrock's and now ZMC, although we're at a different level of maturity in the business now, the areas that they pushed us on and had conversations like, hey, wouldn't it be great to have more enterprise clients? And we would say, well, of course, but how would we get them? And they would sort of say, well, let's talk about how you get them. And suddenly we're executing a strategy that took some time, but helped us get to a place we wouldn't have gotten without it. We got more sophisticated with our own internal tracking and accounting systems and the way that we look at the KPIs and metrics of the business. We had been always growth oriented and not necessarily looking at the mechanics of the business with the amount of rigor that we look at digital marketing for our clients. And, we focus that lens internally and we are a much better run. We're able to make far better decisions based on data at a much larger size than we would be able to do had we not started the process of getting really rigorous about our own KPIs and metrics. And it was Shamrock that really urged us to go there, and it was to our benefit. And I wouldn't have known how impactful that could be.
So what I'm fascinated to hear? You did a couple acquisitions on your own, and then now you're going to do an acquisition with Shamrock. What was the biggest difference, either in the level of detail, the analytics, the questioning, the modeling? What did you notice as difference there?
Well, I'd say private equity, those are deal people, right? Their whole business is doing deals. They're good at it. So I looked at like their support in the 3 deals we did after Shamrock. They really helped with the heavy lifting of the actual sourcing, closing, legal mechanics. Like they helped the deals get done from start to finish, vet, decision, and then literally get them through the finish line. So without us having, we didn't have, we still don't have like a dedicated corp dev team that does this. So we leaned on them and they were really impactful. And ZMC it similarly brings that to the table. PE people are deal people and they love doing deals. So now some of those, in this particular case, they were very helpful because it was the right thing for the business. They weren't even doing that because they were putting in more of their capital. We didn't need to actually use their capital to do these deals, even though they had, volunteered to put more capital to work. Bigger deals would probably require that, but we just didn't require that in the deals we did.
So here's another thing I hear a lot of. I think entrepreneurs are concerned now that I have a private equity group as a partner, they're going to show up one day and say, hey, Mike, here's a company we bought or we're going to buy. Doesn't work like that, right? You guys set strategy. Where are the verticals we need to be? Where's the services we need? Yeah. Can you comment on what the process was like to source those deals?
Yeah. So we approach it. Some of it is opportunistic, right? Private equity, once the market saw that we were partnered with Shamrock, they would get deals that come to them saying, hey, would Wpromote be interested? Some of it kind of comes over the bow, but we really approach it strategically. What are the gaps in our business? What are we trying to accomplish? We're not, there's a business model, a common private equity business model, which is like rolling up an industry. Like we're going to buy a company and let's buy 20 others like it. And we're going to become the biggest plumbing company in the Northeast or something. That's a very different business. And then the way we look at it, which is strategically opportunities. How do we get better at areas that we're weak in? How do we fill in gaps to become more attractive, enlarge in the center of the bullseye, whatever the strategy is. So we're doing this right now again, right? Is what are the areas that we want to focus on? And then let's go and find the companies that fill that, right? Like, Amazon's exploding. Let's go look at retail media focused agencies and teams, and let's go you understand that market and go meet everybody, whether or not they're for sale. And we would do that sort of categorically. And we looked at many dozens of companies and to ultimately do, 3 transactions with Shamrock and 2 before that. It's definitely, I think, the right way to look at it. There was never a situation where they're like, hey, buy this company, or like, hey, we teed one up and we want to, or hey, buy our other portfolio company. That was never.
So I'm going to ask it this way. I'm sure you found a vertical or a weakness that you wanted to improve on. You found companies in that space that scratch that itch for you, and you chose some over others.
Yeah.
What were the main things that excited you about a potential acquisition versus disqualified one? Maybe a couple of points on each.
Yeah. So I think, for us, the requisites were, did we like the team? Like, I look at this as,
That's number one.
We won't do a deal. I mean, if it's a horrible business and a good team, you wouldn't do it. But like, we will not do a deal if we don't want to work with those people, that we like them. There's a cultural fit. We think they share similar values. We think and same, by the way, with private equity. If you don't even have a connection with them during the, hey, let's all put on our best faces and get to know each other, if that you don't click, then you are certainly not going to click with them. You better be madly in love during those, when everyone is, happy, right? When times are tough is when people, you see people's stripes. So do we like them? Do we want to work with them? And then we're very, very, if there's two things and they're tied, it would be the people, and are we excited about their business? Now, what we're excited by may vary, but like, do they have clients that we think that we're excited about growing? Do they do something better than in an area that is stronger than what we have, and we can bolster that on a larger platform? Do they, do they have relationships inside a vertical or industry that we think we could leverage and tell a really great story on a broader scale? And do they have several of those things? But yeah, I'd say it's people. And so interestingly, I think it was not, are they this particular size? Do they have this profit margin? And none of the things I mentioned were KPIs in the business, right?
Right.
And in fact, I will say, this isn't like one of these avoid at all costs, but it actually falls into the con category for me when I see a company that seems overly optimized, right? Like it's almost like you've squeezed all the juice out of the orange, and it's optimized to maximize profits and maximize growth, sort of optimized to sell. Usually, while that may appear attractive, it actually can be hiding the kind of the warts in the business. I'd rather see that.
Yeah. Is that a big red flag, or is there something else that you would say is also a red flag?
I'd say it's a yellow flag, right? It could be a great business that just is a great business. But if you're packaging it up to sell, you're optimizing, you kind of want to hide the negatives, or, kind of muddy the negatives and accentuate the positives. And you have to do a little bit more digging to like get the full picture. So I'd say it's a yellow flag. Okay. To be a red flag is like, a red flag would be if you ask what potential headwinds might be in the business and they say there are none, right? That's a red flag. If they're not, I mean, for me, I think, and this is the way I look at the business, and, I like to draw attention to the areas that we're not strong in, because I feel like that's an opportunity. It's like, hey, we haven't squeezed all the juice out of the orange. This area of the business
is right.
Has huge growth potential. If you have, it's kind of, to look at it, it's a little different, but it's like, if you have 90% market share in something, I'm not saying we do, but like, if you have 90% market share, that means there's only 10 left to get, right? There's not a lot of room for growth. If you have 2% market share, you've got 98% left to grow. I'd much rather have, acquire a company or be interested in a company that has huge amounts of headroom than one that has already swallowed the business. That might be a cash cow, but I'm looking to grow, and that's not a growth business necessarily.
Yeah, and I'm keeping my eye on the clock for us, Mike. This is great. So now you're 160-ish million, you're 20-something% EBITDA margins. Tell me about the conversation you have with Shamrock that says, we're ready to move on to somebody bigger. And then how is that process of deciding who's our next partner? How is that different from just partnering with Shamrock?
Yeah, so it was quite different. So the process started about a year ago, a little over a year ago. We were having a tremendous growth year in 2021, and just a ton of momentum. At that point, from start to finish, a process going through a real process can take about a year. I mean, granted, half of that is kind of prep and just figuring out the timing and so forth. But these are not short. And so, the thinking was, hey, at the time, Shamrock was 3.5 years into their investment. It was clear that things were, on a really terrific growth path, and that, a private equity business model is you invest money in a company, and somewhere in 4 to 7 years out, and 7's kind of long, they exit that position and they return money to their partners and their investors, their LPs. So, that was when the beginning of the conversation happened. And so partly it was just kind of, talking about those arcs of growth. That was kind of, we were in the, year 3 of kind of a 4-year arc of growth. And what that starts happening is you start thinking about optimizing for a little bit more about the near term than thinking about investing in the long term. And that, to me, is the time that you need to start thinking about it was less, we need a bigger partner, and more, we need a partner that's in the beginning part of their investment, right? So with ZMC, we're no longer talking about 2020. I mean, we're talking about 2023, but what we're really talking about is, what do we want to be in 2026? That's fun stuff. Like that's investing in things that take a longer period to come to fruition, technology and new strategies and different areas, versus, what's going to bring clients in 3 to 6 months and have an impact on, the immediate. That's, to me, less fun work. I like, what got us here was thinking long term. So there was a natural arc to that.
But you also have a mechanism that thinks about 3 to 6 months and where new clients are coming from. You got all business development. You don't have to deal with that anymore.
For sure. So yes, that is kind of the mechanics of the machine now. Kind of, that's the way it works. So my time really is, frankly, much more about 12, 24, 36 months out. And we have much of the day-to-day team is focused on making sure we, hit our numbers in the 3 to 6 months.
And so when you did your outreach, was it you blasted out to the kind of entire ecosystem? And how many face-to-face meetings did you have? Any of that stuff you can share would be great to hear. So
I wanted, because I'm staying in the business, the team's staying in the business, while it's an exit of sorts, I still have a significant, and management team, significant ownership going forward. To me, finding the right partner was as important as finding the right outcome. And so I invested a lot of time before we even officially kicked off anything in getting to know several dozen of potential players that have shown interest in our space and would likely be involved in the process. I bet I met pre-process close to 30 players, maybe 20 private equity, 10 strategic of different shapes and sizes.
And you met them like this, or you sat in front of them and you?
I'd say of that 30, a lot were virtual. I'd say maybe probably half and half. I mean, when I could tie it to an in-person, it might be casual, just grabbing coffee or whatever.
Yeah.
I'd say probably half and half. I think I think when the process went out, I think there was probably outreach to probably close to 100 total, with maybe about half that wanted to sign an NDA, take a look, et cetera. And probably about half of that, probably about 24, that took a pretty significant look, which is, I think, a pretty healthy number. I think, especially in the 2022, when you have, we saw it. There were some, very sophisticated investors that said, "Hey, we're actually like what you're doing, Wpromote. We think you're going to be a winner in the space. We're bullish on it, but we're just nervous about the world right now and want to see where things shake out. And we're just not going to do many deals right now, or do no deal. Pencils down until 2023." Obviously, that's not good for us trying to, mid-process. But and then others, I think, look at it much more the way that I would hope that people look at it, which is during, challenging times, this is when the best opportunities are. You don't want to buy high. You want to find great opportunities. The last crop of multi-billion-dollar unicorns came out of 2008, right? And so, to me, this is exactly the time you should be, as a smart long-term investor, looking at opportunity. Is not when things are frothy and everyone else is, but it's when some are when half the team is saying pencils down. That's your time to find really great companies.
And it's also time for people that want to be your partner to really raise their hand and self-select, right?
Totally. Yeah.
And was ZMC on your radar screen early or no?
So when I talked about those kind of 25 or 30 that I sort of had, hey, just get to know kind of the players. They were in that group, had a very quick connection with them. They are entrepreneurial. They have they too, I think, would say they punch outside their weight class, right? They try to do more ambitious, bigger deals. They're hands-on in a way that I really like. They're looking at business development opportunities, and we're several weeks in, and we're looking at M&A, and we're so I think very active in a way it's less like all up in your business and more like, hey, how can we help you grow and therefore help us accomplish big things.
And how many LOIs did you get?
Well, I'll share probably rough numbers. We of the maybe 24 that took a pretty good look and had meetings of some sort. About half of those, took meaningful next steps, which is, I think, probably pretty decently high numbers. And about half of those, took kind of the next step as you kind of go from first round to second round. That you'll hear often. In the end of the day, you only need one, and you can have only one. Right. Obviously, the more eagerly interested a cohort, the more likely you are to get a great outcome, and not have a busted process of some sort.
Sure. And ZMC is minority or majority now?
So they're majority now. So they're majority mathematically because they took out Shamrock and another chunk of the business. So I'm still a really significant shareholder, but mathematically a minority versus ZMC. So
and then I'll wrap us up. But tell me, when you guys whiteboard where you think M&A is going to be important, what's at the top of that target list for you?
It's funny. We just kicked off the planning session last week. So areas I can say that we look at as big opportunities and M&A opportunities. There's sort of both hire and acquire opportunities for us. I'll candidly say it because we could use the great.
You never know.
Is definitely around performance, creative, and video. I'd say is one category. The second is around what we call our take on streaming plus linear TV is called converged TV in our world, and converged TV is an area that we're really excited to grow. And the third is international. Although we and that's probably we've made a lot of progress in that, and I think we're actually resonating really well with global North American headquartered global firms, but those are kind of categorically where we're having conversations. And
so then international, it would just be something like kind of a basic performance agency of size somewhere else in the world.
Yes, hypothetically that would be the area it would look. We're also looking at areas around strategy, around implementation, around emerging platforms, like TikTok focused creative agencies is kind of a category that we're noodling and kind of building and looking at acquisition opportunities as well. So we're definitely we'll be looking pretty ambitiously at those strategic bets.
If we had another hour, I would take all of that next hour, Mike, and I know you don't. I know you got people pulling you in all sorts of directions. The fact that you gave an hour and shared so openly is terrific and greatly appreciated. So I will say thank you so much for that. It'll be a great fun now to watch Wpromote go through the next few years. I know of the people at ZMC a little bit, and seems like a terrific group, and you have a great partner. So thanks again for making time. Thanks for the people at Team Shares. Congratulations to the people at ZMC and also at Shamrock. And that's it. I don't know who else to thank, Mike, but it was great to have you here.
Appreciate it. Enjoy the conversation, and I look forward to the next couple of years as well.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.